The next topic we have is the equity method. Let us see where do we stand, what we are doing. Let's just make some sense out of it. We discussed that if you have investment between 0 to 20% in some company, in some company's common stock, it means you have little or almost no influence. So in this case, we use the fair value measurement, right? Whether that company is listed or unlisted. Now, what if you hold investment that is between 20 to 50%? Like, for example, I have investment in Ahrar Incorporated. It's a listed company. And I hold 35% stock, common stock of Ahrar Incorporated, for example. So in this case, I cannot use the fair value measurement. Why? Because 35% is quite a significant investment. It's quite a significant investment. So I definitely exercise some significant influence. Now I have two options. How do I book in my accounting records? The first one is the fair value option. And the second one is the topic for tonight. What is fair value option? I'm going to book this investment. Let's say when I purchase this investment, it cost me $150,000, right? And I purchased them on, let's say on 31st of October, 2021. Now, when the year closes on 31st of December, 2021, the investment now has a value, the fair value, 220. Now, what I'm going to do, I'm going to book this 70,000 as my gain in my income statement, right? What happens next year? In next year, 31st December 2022, the investment falls from 2022 to 190. So in the next year, I'm going to report $30,000 loss in my income statement. Then how come? How come is it different from the fair value measurement? Remember, the fair value measurement is applicable between 0 to 20%. But if you hold between 20 to 50%, then you need to apply the fair value option. And once you elect the fair value option, you cannot revert. It's a one-way ticket, right? So using fair value option means you purchase the investment 35%. You every year at the end of the reporting period, you remeasure it to the fair value. Any gain is reported in the income statement, any loss is reported in the income statement, and you keep on doing that again and again and again till you sell the investment. Once the fair value option is elected, there is no way back. Now, can anyone tell me, can anyone explain why is it so once the fair value option has been opted, you cannot back out? Yes, so if you elect fair value option, you have to remeasure these values of investment every year at the end of balance sheet or at the reporting period. Any gain or loss is reported in the income statement. If you could move to equity method, what the firms would be tempted to do, they will keep on switching between the equity method and fair value option. When the stock price is going up, when Ahrar Incorporated was doing well, the share price goes up, I would prefer fair value option. When the stock price starts falling, I will switch back to equity method. And I keep on moving this way. Whenever I find suitable, I will move between these two. So this is something that US GAAP doesn't allow. So once you elect the fair value option, alas, finished. You can't move back. So now the second option we have is the equity method. When it is applicable, when you hold between the investment 20 to 50%. Let's say I have another company, let's say Ansar Incorporated, and I have 30% investment in Ansar. So clearly this falls within this bracket of investment. Now at this time I have selected the equity method. How do we bring this into accounting records? Let us discuss the accounting aspect and let us discuss how do we go about it. So when you hold 30% investment in a company like Ansar Incorporated, that means I exercise significant influence. I exercise significant influence over investee. Means, remember, investee here means the Ahrar Ansar Incorporated. That's what we're discussing. So we have two options. Either we go for the fair value option or for the equity method, assuming No fair value option was elected. So equity method means when you make the investment, you make this entry, debit the investment account, investment in Answer Incorporated, whatever the amount you have paid, $150,000, and you credit the bank or cash, whatever you have paid, or any other consideration. Maybe you might have issued some bonds, you may have paid cash, or maybe you may have given some preferred stock, or any consideration, anything in return for this 150,000 investment in Answer Incorporated. So this is the entry you make. Now listen to me. This amount will not change with the changes in the market price of Answer Incorporated stock. If the price goes up or goes down, investment account stays at $150,000. Right? Investment account stays at the same amount. How does it change? At the end of the year, Answer Incorporated earned $100,000. Right? This is the income Answer Incorporated earned. Since I hold 30% investment in Answer Incorporated, I am entitled to 30% of this profit. I will consider this 30% of 100,000, 30,000 as my income, and I am going to report it as a part of my income statement. Even I have received nothing. Now, I hope you can reconcile this with the cash flow statement. If you remember, let me take you back so you can link things up this way. Now look at this line, income from investment in equity method investee. I received $30,000, and this $30,000 is included in my net income because I have 30% investment in Answer Incorporated. So this 30,000 is rightly added to my income statement. But the question, did I get any cash? Absolutely no, I didn't get any cash. I haven't got any cash for this income. Why I am adding it in my net income? So in order to remove this non-cash impact, I am going to remove this 30,000 from my net income so that I can convert my net income into cash flows. That's the point. Let's move on and discuss another aspect to it. Now let's say if Answer incurs a loss of, let's say, an imaginary number, $90,000. Since you took 30% of income as a part of your income statement, you have to consider the loss as well. So if there's a loss, Answer makes a loss, $90,000, I have to charge this 30% of this loss, which is $27,000, against my net income. So you take proportional part of profit, book it as your income, and you take the proportional part of loss and take it as a loss in your income statement. Now the question, this is a loss. Did I pay any cash for this? No. Did I get any cash for this income? No. Since both of these, this gain and this loss, they are non-cash. That's why gain must be deducted from your net income and loss must be added back. Let me show you. So loss on investment in Answer Incorporated, Answer happens to be my equity-based investee. So this $27,000 loss, which I have deducted from my net income, right? So it has to be added back. Right now it makes sense that gain needs to be deducted on equity-based investment and loss needs to be added. Similarly, there is some questions that remain unanswered, Ahmad. We haven't yet discussed why do we add the amortization of bond discount? And why do we deduct the amortization of bond premium? So just hold on, answers are coming. Things will link with each other as we go along when we will do our long-term liabilities, inshallah. So now we got the understanding. When your equity-based investee earns an income, we consider the proportional part as our income and a proportional part of loss as our loss in the period. So let us see the accounting entry also. Here it is. So when there is an income, you book income this way. You debit the investment account, $30,000, and you credit the revenue or the income in your income statement. This goes to your income statement. And when there is a loss, you do the reverse. You debit the loss account and credit your investment account. See, this is how we bring in any increase or decrease in investment when there is income or when there is a loss. It has nothing to do with the market price. Market price may go up or down. We are not concerned. We are only concerned with any gain or loss. So this is what you call the equity method, right? But under the fair value option, your investment are revised at the end of every reporting period. If the price goes up, it's gain. If price falls, it's loss. So I hope you would have made the difference. Now, I think it's all covered. Now, there's some fine point that we need to discuss here. Let's say there is another equity-based investee, Ahmad Incorporated. I invested 40% in the common stock of Ahmad Incorporated, and I did it on 1st of July, 2021, right? And now the year is ending at 31st December, 2021. Ahmad has earned a total income of, let's say, $60,000 for the whole year. Now, the question is, I should ask you, should I consider 40% of this as my income? I hold 40% investment in Ahmad Incorporated's common stock. So I should take credit of 40% of 60,000. Am I right in doing so?
Yes, sir.
No, I'm not right, because I purchased shares in Ahmad Incorporated on 1st of July, 2021. And now I'm reporting at 31st December. So I actually held on to this investment for just 6 months out of 12. So if there is a total gain of 60,000, I am only entitled to take 6 by 12 part of it multiplied by 40%. Right? So this is the point you need to remember, right? If the investor's share of investee earnings or losses is recognized only for the portion of the year, the investment was held under the equity method. Since this investment was for 6 months only, from July to December, so I am going to take just 6 months out of 12, and that 40% will be reported as my income for the period. So this is an important point to be noted. And now, let me give you a format which you're going to use to solve many equity-based questions, equity method-based questions. Please note it down. It's quite helpful. This is your investment account, whether investment in Ahrar, Ansar Incorporated, or Ahmad Incorporated. So you will keep this investment account. They will maybe there's opening balance available previously, or maybe you would have purchased this investment during the current period. So either you will have the drawdown balance, or you would have made this investment during the period by debiting the investment, crediting the bank, right? It's a new investment. You will have bank here, else you will have an opening balance. Yes, Khidr, we are going to discuss that as well. So brought down bank, if there is any income, if your investee, equity-based investee, Ahrar or Ahmad or Ansar, they earn something, you take the proportional part of it in your income statement. So you will debit this in your investment account. The entry you have just learned, let me show you the entry also. This is the entry. You debit the investment in Ahmad account, credit the revenue. So this is the part I'm talking about, the credit part. And if there is a loss, you're going to take loss on the credit side. That will reduce your investment, right? And if your investee pays you a dividend, this is important point, Khizr. If the investee pays you a dividend, this dividend will no longer be considered income, because you have already considered this income here. Khizr, income has already been considered. So when this company X Incorporated, it pays you the dividend, you should not consider that dividend as income again, because you have fully considered proportional part of the profit as income. You can't double count. You should not do that. So when you receive the dividends, the entry that you make is you debit your bank, and the credit is given to the investment account. Remember, so when you receive dividend, debit bank, or if dividend is receivable, you debit dividend receivable. If it is due, you credit your investment account. So dividend appear on the credit side of your investment account. Please write down this format. This format will help you solve many questions of this type. So this is the entry. When you receive dividend, you debit cash or bank or dividend receivable, and you credit the investment. So dividend from your equity-based investment is not an income. Rather, it is credited to the income account or to the investment account. Okay, now, let's say I kept 35% investment in Ansar Incorporated from 1st of January 2025 to let's say 31st of July 2025. This was there. On 31st of July, I reduced my investment from 35% to 18%, or maybe nearly 20%. So what happens when the investment falls below 20% or nearly 20%? In that case, you stop using equity method, because equity method is applicable when the investment is between 20% to 50%, because at this percentage, it is presumed that you will exercise significant influence. Yes, exactly. IFRS and US GAAP are they are most of the things they are same on both sides. But whenever there is a difference, the book will highlight that difference up only to the extent of your syllabus, and you must follow the US GAAP. So this is the point you people need to remember. The moment you bring your investment less than 20%, if you are no longer able to presume significant influence, then you should stop using the equity method. Equity method will no longer be relevant once you reduce your investment below 20 or you no longer presume to exercise any influence. So let us do a few questions to grip this concept in a finer detail. A company owns 10,000 shares of a corporation stock. The corporation currently has 40,000 shares outstanding. Now, this tells us if you hold 10,000 shares out of the total 40,000 outstanding shares, that means you hold 25% shares, which is clearly beyond the threshold 20 to 50. So now you can use the equity method. Let's see what it says. During the year, the corporation where you have made the investment had net income of $200,000, and this company paid a total of $160,000 dividends to its shareholders, including you. You hold 25% investment. At the beginning of the year, there was a balance of $150,000 in the company's equity method investment account. At the end of the year, what is the balance in this account? We just discussed that the format that you should use is investment account. You have the drawdown balance. If you have made the investment during the period, you bring bank here. If you receive any income, percentage of income, that is debited to the investment account. If there is a loss that is deducted, there is no such loss. I'm writing the complete format. And then if you receive any dividend, that dividend is credited to the investment account, and this it gives you the closing balance. Now let's plug in the numbers. Your opening investment account had a balance of $150,000. So this is it. $150,000 is the drawdown balance. We didn't make any further investment during the period. It further says that this company earned $200,000 net income during the period. Since I hold 20% investment, 25% investment in this company, so 25% of this income is mine. 25% of this income is mine. So 25%, 200,000 is going to be $50,000. This is the income on equity-based investing. Now, what happens? This company pays $160,000 dividend to all of its shareholders, right? So this $160,000 has to be taken at 25%, because out of this total dividend, I am only entitled to receive 25%. So 25% of 160 gives you 40,000. So if you add all these 150, 50, 200 less 40, so the closing balance in your investment account is 160,000, and that makes C to be the correct option. Absolutely right answer, Ms. Yamna, you got it right, Vakas. Excellent. So this is how we find the unknown balance. So any of these might be missing. Maybe you're given the opening balance, closing balance, you are given the dividend, you may have to find the income. So one of these might be missing, so you can just work it out in the reverse order. All right, so that makes C, 160,000 to be the correct option. Next, a corporation acquires 30% voting interest in the another corporation. So we have two options. Either we go for the fair value option or we go for the equity method. In this situation, the long-term investment is generally accounted for on the investors corporation books of account using which of the following method? Load of cost of market. This is wrong because this is used for inventory valuation. Not at cost. Not consolidated, because for consolidation, remember, you need to have more than 50% up to 100% for consolidation. Remember, consolidation is a very complex topic, and you will be just touching it. Otherwise, consolidation in its full form is quite a detailed topic. So this is not true again. So that is D clearly. D is the right answer. All of you are right. D is the correct option. Okay, now this is it. When an investor uses the equity method, means when you hold between 20 to 50% investment, right? So when an investor uses the equity method to account for investments in common stock, the investment account will be increased when the investors recognizes. We studied three entries. Let me write down these entries. When we make the investment, we debit the investment account, credit bank at the time of when the investment is made. This is the very first entry. When your investee earns some money, you debit your investment account, earn some profit. Investment account is debited and you credit it as a part of your income statement. Or if there is a loss, you make the reversal. Now, when the dividend is paid, you debit the dividend and you credit the investment account. So these are the three entries you must be familiar with. It says when the investment account increases. Now you can compare these options with the entries I made. First, a proportional interest in the net income of investee. When your investee makes some profit, you take 30% or 40% of that income and you book it as an investment debit income credit. So that makes sense. This is true. A proportional interest in the net income of the investee. Cash received from the investee in the form of dividend, no. If you receive dividend, that will reduce your investment account, right? Receipt of dividend will reduce your investment account. So yes, A is the right option. Periodic amortization of goodwill. Goodwill arises when you acquire more than 50% shares of investee. In that case, we require consolidation. We'll discuss that briefly later on. As I said, consolidation will be just touched upon because this area requires just a little knowledge as far as the calculation of goodwill is concerned. Otherwise, it could be quite a long topic for proper professional accountancy qualification. Okay, next question. A corporation received cash dividend from the common stock investment. Should the corporation report an increase in the investment account if it uses fair value method or the equity method? So what basically do we do with this investment under the fair value method, under equity method? Please remember, gentlemen, fair value method, that is the fair value measurement, the very first. When you hold between 0 to 20%, you apply fair value method. And when you hold below, above 20% and less than 50%, you go for equity method. So under fair value measurement, when you receive dividend, you debit cash or bank, whatever the amount is being received, and you credit the dividend income. Right? And when you receive dividends from your equity-based investee, in that case, you debit cash in bank and you credit the investment account. This is what we've just discussed. Now read the question again. A corporation received cash dividend from a common stock investment. Should the corporation report an increase? Let me highlight the specific part. An increase in the investment account if it uses fair value method or the equity method. So if you just look at these both, investment account is not increasing in both of these cases. In this case, there is no investment account. And in equity method, there is investment account, but it is decreasing. So in none of these methods, investment account would increase. So it's no. So Ms. Yumna is right. She is the only one who is right. All of you have given the wrong option. All of you have given the incorrect answers. It's no. Remember, under the equity method, you debit cash, credit investment when you receive dividends. And under the fair value measurement, you simply debit cash, credit the dividend income. In none of these methods, investment account is increasing. So that makes no, A to be the correct option. So this is a question for you. Ibrahim, you were asking a little while ago. What about when you sell the investment? So this is it. It's a little difficult question. Please be with me when we are solving this. A company A acquired 30% of company B's voting rights on January 1st. 30%, clearly this is within the bracket 20 to 50%. Voting rights on January 1st, year 1. And account for its investment using the equity method. That's what we have been studying so far. What happens on January 1st, year 2? Company A sold 60% of its investment in company B. 60% investment has been sold for $150,000. Okay. The carrying amount of the investment on January 1st before the sale was 210, and the fair value of the retained investment after the sale was 100. Now we have to establish how much gain or loss, if any, on the disposal of the investment was recognized in year 2, income statement prepared under the IFRS. Now, we have to compare two things. First, the opening balance of your investment had a balance of 210. This was the opening balance, 210. You are selling 60% of this investment. And this 60% sale brought you how much? 150. Okay. After selling off 60% stock in this investment, you had total of 30% investment. And out of that 30%, you sold 60%. After selling off 60%, the remaining amount, the fair value, the remaining amount of investment is $100,000. If you compare these two, the opening value was 210. You sold some investment at 150. Still, the balance you have is $100,000. If you calculate the total, it's 240. It's 250. The gap between 210 and 250, this $40,000 basically represents your gain. Let me tell you again, how did we calculate? First of all, you will have to see what was the fair value at the start, 210. Out of this, you sold 150. And even after selling the investment at 150, still the closing balance is 100. So if you add the total of what you sold at what price plus the fair value of the closing balance, 250, compare it with the opening value, the difference between what you had, what you got versus what is left is your gain. So $40,000 is gain on disposal. So that makes B to be the correct option.